Hello, welcome back. It is your Ignite and Co. where the elite go to grow. I'm Erica Benigni.
I'm Shelley Borman.
I'm Lisa Gustafson.
We are back on our Wednesday morning coffee talk, and today we're going to talk a little bit about some of the challenges that our borrowers might face after getting under contract. So a lot of real estate agents and customers are spending all kinds of time out there looking at multiple homes, finally get under contract, and then you may have one of these things happen that could ultimately kill the deal. So we're going to show you or tell you how to avoid that by playing a little game.
Play a little game. So I can't see the card, but they're going to help me guess what it is.
Okay, so this is something that we verify throughout the process, but specifically 10 days prior to closing.
Okay.
And if it changes in the process, it could be a very big issue.
Job
is where,
job. Nice. So we've all had that happen where we call to do our final verification of employment. We find out our customer no longer works at that employer, which doesn't always have to be a deal killer, especially the earlier we know about it.
Right.
Much better if we find that out 10 days prior to closing than 1 day prior to closing. So if you get even the whiff that your clients are changing jobs, please have them reach out to us. The other thing that happens sometimes is they think it's a lateral move and it won't matter, but maybe their hours aren't guaranteed, or maybe they're going from a W-2 employee to a 1099. Maybe it's an
hourly to a commission.
Yeah, or they have a probation period on their job, or they're going to a temp agency and then permanent, all kinds of fun things. So moral of the story is talk to your lender early.
Yeah. All right, you guys ready?
Yep. Okay, Alan Greenspan.
Okay. These change daily.
Sometimes multiple times a day.
All right, interest rates, especially in this market, can they change multiple times a day? And so interest rates is actually really important because it affects your debt to income ratio. A change in interest rates, specifically an increase in interest rates, can be the difference between qualifying or non-qualifying. And so especially when we have buyers who are maybe under contract a little bit longer for new construction, this is especially important. Some lenders, as Loan Depot, has long-term lock options where we can help mitigate this.
Which is lock and shop.
Lock and shop,
where you
yes.
lock in while you're still looking for a home.
Exactly, which we talked about last time. But it's really important for lenders, buyers, real estate agents to really be on top of the interest rates and make sure that we're checking and double checking to make sure we still qualify. Yep. Okay, so this one is part of a ratio. It does have to do with how much you pay out in bills per month.
You're not
Debt?
sure.
Yeah, you got it.
Okay, yes. So this can mean a lot of different things. It could mean new debt. Maybe your clients buy a car. That's kind of the old example, right? Somebody buys a car while they're under contract. But the thing that we see a lot is they co-sign with a family member and they don't think it's going to affect them. And it maybe won't, except usually you have to have 12 months payment history to show that the other person is making the payment. So a newly co-signed debt can really be a problem. So, again, if your clients are talking at all about heading to a bank to sign papers and it's not the mortgage company, let's find out what's going on. And what other kind of debt?
Well, but I think also people maybe think that their credit will not be pulled again in the process. And so they may go out and purchase something, not realizing that the lender will be triggered of new debt.
Yeah. So we do get notified of new debt, even though we're not pulling a new credit report.
So we're going to find out.
Yeah. So if you have a client that does need to buy a new car or need to get debt, just have them. Furniture.
People want to buy a washer and dryer.
Just have them contact us so that we can. Because the other thing is it can affect their credit score too. So
make sure it doesn't kill the deal.
Don't kill the deal.
All right.
Oh, okay. This is the thing where they go out to determine how much the property's worth.
The appraisal. So the appraisal is not necessarily a bad thing, right? You have to have an appraisal on every property. But what we're seeing in this market is especially a potential for an appraisal gap. Right? So a lot of times just to get under contract, people are having to offer more than the home is worth. We're not seeing, in those situations, we're not seeing all appraisals come back with a gap,
Right.
Or come back lower than the ultimate purchase price, but it certainly does happen. And so we need to have a game plan in place. It doesn't have to be a deal killer, but we need to be thinking about the possibility that this could happen and educating our buyers on what that means. What's the worst case scenario? What does that look like? How can we restructure the loan? Just different ideas to get the deal closed, because it is happening.
Right, and low appraisals aren't that common, except in a market right now where you have clients that are bidding 20, 50,000 over the list price. But aside from low appraisal, yeah, we can have appraisals that come in subject to repairs being made, and that could also potentially be a deal killer if you're not working closely with your real estate partners, the sellers, to come up with a solution for addressing those items.
Yep. All right, good one.
All right.
Ooh, okay, so you have to bring this to the closing table.
Your driver's license.
Good, yes,
A pen.
you have to bring that.
You have to give for your lender.
You should be in your bank account.
Fun. Okay, yes.
yes.
So funds to close. I think we spend more time on this than we do on actually verifying employment. And it partly because the government likes to get really involved in this too. Anti-money laundering, that type of thing that we have to verify. So any large deposits into their bank account, we're going to have to verify the source of any cash deposit. So again,
Well, in cash deposits, we actually can't verify. So cash is actually a really bad word in our industry because we can't verify. We can't make sure that nobody associated with the sale is giving you cash to be able to buy the home.
right.
So we don't like cash deposits.
Right.
We have to be
We're
able
not
to
like on
verify.
Ozark where we're laundering, washing it. Yeah. So funds to close it's where we spend a lot of time, and it's kind of counterintuitive to a lot of clients because they don't understand why we care. So again, if their earnest money check is going to come from a relative or another source, or if they're talking about cash to get a money order or something for that, have them call us. Let's just make sure up front that we're getting the documentation that we need so that we have a smooth transaction.
Right. Absolutely. And let's remind all of our buyers to bring a gift for the lender to the closing table. As Lisa said.
But not cash.
I'll take it. All right.
Okay, wait. This is our bonus question.
This is the bonus.
This is worth extra points if you can get this. Okay.
$100,000 pyramid, $100,000 million.
All right. So
This
this
is a
is
report that we pull.
no.
We pull the fraud report.
Okay, wait, this is
It's
where-
the opposite of your debit card.
Your credit. Credit.
And why would that be a deal killer?
So everybody has a credit score, right? And so
Yeah.
most
We'll
people.
do that one next.
Yeah. So credit is important. So when we pull a credit report, it's good for 120 days, which for a lot of people is just fine. However, if somebody's having trouble getting under contract, for instance, or if it's a new build that's not closing in 8 or 10 months, let's say, we do have to re-pull a credit report. And there are minimum credit scores to be able to qualify for a different loan program. So if there are collections that pop up or late mortgage payments or something, all of those are going to affect your credit.
If their credit card balance goes up, that
Yeah.
can drop their credit score.
It could drop it.
Which not only it can affect them qualifying, but also it can affect your interest rate and your mortgage insurance premium.
Yeah, monthly
We wanna
payment,
keep
which
those
could
credit
affect your
scores.
debt to income ratio. The whole thing.
But it doesn't have to be like that.
No, it doesn't have to be.
You work with a mortgage professional who is counseling your clients throughout. We can avoid almost all of these.
All of these, yes. And I think the main thing is just addressing them sooner than later. Make sure that you understand that your lender is on your side.
Yep.
We want to close the transaction. The more that we know and that we can address, the sooner the better.
Absolutely. So hopefully this will help you keep your deals from dying, because nobody wants that. We all want all that hard work you did, showing the properties and getting them under contract to end up with a really happy homeowner and future referrals for you. So
Absolutely. Cheers.
cheers.